All right, Charlie, I think we're live.
Awesome. Welcome, everyone.
Yeah, thanks for joining us today. And thanks to everybody that's hopping on here. Excited to do our halftime report with you, Charlie. It's been an eventful year, so I think we'll have a lot to talk about,
Interesting last few months, to say the least.
to say the least. All right, we will give a few minutes here for everyone to jump on, but while we do, let's get through a couple quick items. So first thing, introduce the agenda today. So we're going to talk, obviously, about kind of what's been going on the first half of the year. We certainly don't have time to get into everything, but we've got an action-packed agenda here. We'll talk about the price of admission, a comeback for the ages, the world strikes back, which to me just has like a little Star Wars theme to it. So I'm excited for that. One big beautiful bill, the Fed, and then we'll do our best to save some time for Q&A. So it should be good. Before we get into the actual content, for anybody that doesn't know Charlie, you should follow Charlie on X, follow his blog at Bilello blog. Um, Best insights you'll find on the market, on the internet, and the best visuals too. Love the charts you put together, Charlie. Um, First one, if you have any questions, please submit those. We'll take some questions as we go if we see them. I mentioned we'll try to save some Q&A time at the very end, but you can do that using the Zoom feature for Q&A and just type those in there and we'll see those. Some of them will even answer kind of offline for you. So please take advantage of that. And then also please keep in mind that the content of this webinar is not investment advice. We're not acting in any form of investment advisor here. So, this is for educational purposes and please use it in that regard. Also, if you like this type of content, you like the types of webinars that we put out, please check out our YouTube channel. That's where you'll find a replay for this. And also go ahead and punch that subscribe button and you'll always be up to date on similar type content that we're working on to keep everybody informed on what's happening in the markets. And we'll get into the fun part and start this off, Charlie, with our first section, which is the price of admission, and our first chart, which is like a bloodbath here or something very ominous looking.
I had to put this in red. Yeah, it's it's something that we experience each and every year. The amount is different. The good old drawdown, the average drawdown intra-year in any given year is around 15% historically. And this year, as everyone knows, we crossed above 20% in terms of the drawdown. We had a good old-fashioned bear market. And this is what I call the price of admission, because in order to receive the upside in markets, you got to be able to tolerate the downside along the way. And 92% of the time, historically, Caleb, if you're a stock market investor in the US, you're going to be in a drawdown, not at an all-time high.
Which means though 8% of the time you are at an all-time high, which is the one thing that this chart maybe doesn't capture is those higher highs. And I don't know about you, but when we planned this webinar, I think back in April, I didn't think we'd be sitting here talking to each other, sitting again at all-time highs in the market. Are you surprised at where we're at?
Absolutely. That had happened this quickly. Absolutely. And I think we're going to talk about that in a little bit. But one of the greatest comebacks, greatest recoveries that we've seen in history.
And this chart gives us a sense of what some of those ranges have looked like, though, right? Just talking more about the drawdowns themselves.
Yeah, since 1980, it's been about 14%. If you go back the last 100 years, about 15%. And you want that upside as an equity investor, and everyone would love the upside without the downside. Unfortunately, that's impossible. So what you're seeing here is a chart showing you that intra-year drawdown every single year since 1980. And you could see, despite these drawdowns that can be sizable at times, overall S&P 500 is annualized at 12% a year since 1980. Of course, the last 100 years, about 10%. And so really the lesson here is there's no reward without risk. And even in years like this, where you have a 19% drawdown on a closing basis, over 20% on an intra-year basis, that didn't prevent the market, obviously, from coming back. And currently, it's up about 8% on the year, including dividends, which is remarkable. But we've seen this before. If we go back to 2020, we had an enormous intra-year drawdown around 34%, and the market actually finished that year higher, up 18% on the year.
Yeah, it's incredible just to see the dramatic ranges here and look back at some of these periods. I think one of the things I was surprised by is just how few years, especially recently, we have a tight range, between that drawdown and the upside. Um, do you think looking at drawdown is one of the better ways to think about risk in the market? I think when we think about the equity risk premium, usually we think about much smaller numbers than this. But do you like drawdown as a measure to really think about how investors should be thinking about needing to take on risk?
I do because it deals with how much you're actually losing instead of looking at a volatility number. If you say volatility is 15% or 20%, most people don't understand what that number means, but they understand that their account's down 14% or 20% or 30% from its high, and that's the number people really care about.
But then we look at a chart like this, right? And those drawdowns look so small. It seems like the trend is just up and to the right.
Yeah, when you zoom out, everything looks great. I'm showing you here a chart, a growth of $1, total returns from the S&P 500 going back to September 1989, which is the start of the S&P 500 total return index. And it's really just one crisis after another, Caleb. And many of these you probably forgotten. A lot of these you'll remember, and they'll have sometimes vivid memories. But I think the lesson is once you zoom out and with the passage of time, there's always been a recovery, no matter how bad the event, whether it's the dot-com bubble, the housing bubble, the financial crisis. We've had, in recent years, obviously the COVID crash. We had the inflation spike, highest since the early 1980s. And this year, of course, the tariff tantrum once again. And that $1 over this period of time grows to $38, including dividends. So 38 times your money. If you could kind of zoom out and ignore the short-term bad thing that's going on, and almost always there's something bad that's going on if you read the news. But the question is for investors, is that thing going to matter 10 years from now, 20 years from now? And what we said about the tariffs, what we've been saying is even if you assume the worst case scenario in terms of the tariffs, which seemed unlikely in early April that was going to play out. But even if you assume that, my argument was that was not likely to last very long. They were likely to change that policy because of the market's reaction, or you have a new administration that's going to come in and remove that tariff. So nothing's permanent in terms of bad news. There's always good news on the horizon. And the markets are dynamic and companies are dynamic. So really the question is 20 years, 30 years from now, are we going to continue to see economic growth, earnings growth? And if we are, the market's likely to be much higher than today. So taking a rationally optimistic long-term view is the way I think about investing. And you just have to be mindful you're going to have these crises all the time. And that's just a part of investing.
Charlie, I don't know about everybody else, but I definitely had your voice in the back of my head back in, February, you know, when the market was kind of reeling and everybody said this was the tariff tantrums and everything that's happening, said it was going to have a huge impact, launch us into a recession. I was just thinking about that chart that we've looked at so many times, there's always a reason to sell chart. I actually showed it to some people in that same time period and said, like, do you remember this? Remember when, we almost had a bank collapse, not too long ago, and
Yeah.
how quickly we got over that. So I do think that sense of, rationality, has been great to look back on. And then also remember you saying, every time the VIX is in, the 2025 range, that's been the best opportunities to get into the market over the last handful of years. And that kind of proved to be true again this time around.
We got a huge VIX spike, and I was all over that in April there, and we actually had a close above 50, which was very, very, very unusual. And I put out a table that day when the VIX closed above 50 of what's happened in the past every time the VIX has been above 50. And every single time 1 year later, the market's higher. And every time the VIX is over 50, there's something terrible going on in the news. So it's very hard to ignore that and to just buy more. But in the past, it's worked out. And when you look at the comments, and I've gone back to it a few times from that post that I put out on X, almost universally people were negative and saying, well, this time's different. We never had a tariff situation like this in the past. It was all of these negative responses saying why this time the market wasn't going to be higher a year later.
And here's kind of a collection of those reasons, right? And I guess in this case, the table is a little bit more data centric than the chart, but I mean, yeah, just so many, and the average decline there is pretty significant as well.
There's so many. This is 30 now. So 30 corrections greater than 5% since the March 2009 low. And if you ask people, what is the S&P 500 up since then? Most people would say, well, I know it's higher, but how much higher, they probably wouldn't be able to tell you. Including dividends, it's actually up over 1,100% over this period of time, despite these 30 corrections and despite four bear markets in the last 7 years, which is pretty unusual. Historically, we average a bear market roughly once every 4 years. We've seen four in the last 7 years, and they've all been different. They've all had different reasons, and they've all had different recoveries, different responses. But the one thing they have in common is that it ultimately recovered. Ultimately, the news got better. Ultimately, the market looked past this. Ultimately, earnings went higher. And ultimately, the patient investor was rewarded. And so this 21% decline, Caleb, won't be the last one. We're going to see another bear market. Hopefully not this year. Don't you have to go back a long time to see two 20% bear markets in a given year. But there will be another correction. So I'm feeling good. Everyone's feeling good. We're back at all-time highs, but just be aware there's going to be another correction likely this year, greater than 5%. The average year sees 3 to 4 of them going back the last 100 years. And it probably will have a different reason that we're not even talking about today. And that's okay. That chance of that happening is actually okay because it's the reason why you're rewarded for investing in the stock market. It's the possibility, the probability that there's going to be a decline in the future and that we don't know how big it's going to be. That's why you have that equity risk premium.
Charlie, the other interesting number on here, though, that caught my attention right away is that median number of days that the correction lasted at 26. Like, that's tiny, right? Is that a dangerous precedent or kind of trend to be thinking about? That to me seems like it's much shorter than we probably would see if we looked at a much longer term picture of the markets.
Yeah, these are 5% plus declines, so sometimes that can happen very quickly. And remember, the downside usually happens much quicker, right? It just, people panic very quickly and they hit the sell button. We definitely saw that this time around in 2020. You remember that was the fastest bear market in history. And this year, I believe, is the second fastest. So things seem to be moving quicker than usual. And I 100% agree with that sentiment. I've tested it, I've looked at it. So like the volatility of volatility is much higher today than it was before. There's different theories as to why that is. The proliferation of ETFs, of futures, of leverage. You have all of these instruments now, 0 days to expiration options, all these vehicles to bet on the short run. And you just have a lot of money thinking about that short run and either getting extremely panicked or then on the flip side reversing that and really a buying panic occurs. So we're seeing it both ways in terms of the downside seems to be quicker and the upside as well. But if you're a long-term investor, none of that should matter except the fact that you might have to be a little bit more nimble if you're waiting to add money in terms of a big market decline. You might not have as long as you did in the past in terms of might have to act more quickly. So like in April, if you blinked, basically the biggest opportunity was gone because immediately, really the first day those big tariffs were supposed to be enacted, he reversed course and sent out a tweet that changed everything, and the market rocketed higher. It was one of the biggest up days in history. So maybe that dynamic is here to stay where things are just going to move quicker. If you're a long-term investor, you could ignore that. But obviously, anyone who's thinking about the shorter term, that's something that's going to have to be part of your life, like thinking about things just move quicker now than they ever did before.
Yeah, so let's look at that first chart, right? So this is the section where, we had planned to talk about that comeback for the ages, but this chart really shows that kind of V-shaped just snap back, right?
Absolutely. See how quick that 21% decline was there, less than 2 months, essentially. People assuming the worst, assuming a recession, assuming that this was going to be a problem for a long time. And then all of a sudden, one by one, people started to change their opinion very quickly, essentially believing that none of the extreme rhetoric is going to last. It's not going to play out. And we just saw one extreme example over another after another that was reverse course, and the market just rocketed higher with each one of those. And I would say importantly, Caleb, was that in the midst of this, we started to get earnings reports. Right? We started to get first quarter earnings reports, and they were by and large good. And so there wasn't any impact yet from this whole situation. Maybe it's too soon to be seen, but there wasn't. And I think investors were comforted by the fact that earnings are still going up. They're at all-time highs. They're up 10% over the last year. The technology sector is still booming in terms of earnings. Nvidia still had a great report. So that comforted a lot of people. And just the idea that the recession probability has gone way down comforted people in terms of, okay, this is not going to be a quick downturn this year. We're likely not to see a hit to earnings. So now we're going to start assuming the best. So that 30% rally off the April lows was just almost unprecedented in terms of historical recoveries.
And Charlie, another example of your influence over my thoughts. When we were in the midst of that volatility down there, in the beginning of April, I was thinking about, I mean, that one day, right? We've looked at that analysis so many times. It says if you miss the 1 or 5 or 10 best days in the market historically, how much that can impact your overall returns. Like if I don't remember the exact day it was in April, May,
Yeah.
but if you would have missed that one day, that would have been, catastrophic, right?
Yeah, it was April 8th. Yeah, and it was something we actually talked about in the last show we did together. This was before, I think it was in March. It was before this free fall decline. I think the S&P was down 10%. But just said be aware that if you're trying to get out of the market because the market's down and you think you want to buy in lower, you have to be very quick to get back in potentially, because the upside days, the biggest upside days historically have come right around those big downside days. And so we saw that once again this year in terms of this correction. You didn't have much time to get in at a 20% decline. You had a brief moment there, and then it was off to the races. And then it was essentially, okay, do you believe this or you don't believe it? You're going to continue to be skeptical about the situation or not? And the market's looking past all of this potentially bad news and it's running higher. Now, we could argue today, is it being overly optimistic? Is there more bad news to come? Certainly something's coming for sure, but clearly it was an overreaction right at the April lows. And once you pull back that extreme uncertainty, investors were embracing risk once again. And in terms of bear markets, I went back, Caleb, and looked. Since 1950, this was the second fastest recovery off of a low for the S&P 500. Only the 1982 bear market, and you got to go back and look at that chart. It's like a vertical move straight higher. Only that was quicker than this move in terms of less than 3 months to get back to a new high after a low. And the 82 example, I think, did it in around just around 2 months. So incredible speed. So certainly every time is different, as we always say, in terms of bear markets on the downside and the upside as well. And 2025 so far definitely proves that point.
And Charlie, you mentioned, that potential for overreaction on the upside. It gives us a chance to answer one of the questions that has come in already. Every time we're talking about these big recoveries, big moves up, somebody's going to ask about valuations, right? And fundamentals. So with the Cape sitting somewhere in the high, I think 36 or 37 handle right now. How are you feeling about valuations right now? You mentioned earnings were strong, but that's a high number.
Yeah, so valuations basically where we started the year. They're elevated, then they became a little cheaper, obviously, after that 20% decline. But if we look at, there's many different ways to measure valuations, but let's just look at trailing 12-month earnings for the S&P. You're talking operating earnings, you're talking about 25 times. Historically, average is around 18, so certainly well above that. And some people would argue, well, you shouldn't use that because the earnings are going to grow a lot. Maybe they will, maybe they won't. Historically, looking at trailing earnings has been better than forward earnings in terms of trying to figure out is something overvalued or not, because those forward earnings estimates are often subject to change, right? Because we can't predict the future very good in terms of the stock market or earnings. And as you mentioned, the CAPE ratio, we're still well above the 90th percentile. So the US stock market, not cheap. Historically, what has that meant? It's meant below average returns over the next 10 years. And so if you're thinking about the next 10 years, is it likely to be more than 10%, less than 10%? If you're a betting man, you would probably say less than 10%. But how are we going to get to that number? Is it going to be with a decline now and then a rally back later, or we continue to get higher valuations and then the market pulls back? Or simply, is the valuation going to hold here? And some people are arguing, well, with technology taking over everything, it's a third now of the S&P 500. Their margins are fatter. They have bigger moats. Maybe they deserve higher valuations. And that's another way of saying this time is different. So I'm skeptical of that viewpoint. But you could make the case that valuations overall maybe should be somewhat higher today because of this phenomenon. But overall, I would just temper expectations, particularly in the U.S. And we're pretty much back to where we started. So yeah, earnings are up 10% over the last year, but the S&P is up well in it more than that, which means we've had multiple expansion over the past year. And that means that the stock market's outpacing the underlying fundamentals.
AI is going to make everything more profitable and more efficient. So we'll be comfortable in those 30
No
ranges.
question. No question that's going to happen. It's just the question is, how much more profitable and how much of that is already priced in.
All right, Charlie. So this chart shows us kind of the average trend, right? And we're not far from it. But we've taken a interesting course, but when you look at it like this, it doesn't seem that crazy, right?
Yeah, if you go back to April 8th there, it was the fourth worst start to a year in history. S&P's down 15% on the year. And this is going back, to 1990, this chart here showing you very few years were down more than this at this point in time, right? You had obviously 2020, but on April 8th, it was rare company in terms of bad starts to a year. And so it seemed like all hope is lost. It's going to be a down year for the market, but really just like 2020, but the recovery's been quicker. After this huge, enormous advance, now the S&P 500, including dividends, is up 7.5% on the year, which is actually above the average year at this point in time, which is about a 5% gain. And keep in mind that this is following 2 years where the S&P 500 was up over 25% on the year. If we're talking about 2023 and 2024. So pretty remarkable to see this where we are today, actually above average from where we were just a few months ago.
And is that a bad sign? If we see these big gains, does it usually mean things are going to reverse course or keep going?
Yeah, so that's the question. And there's a lot of hesitancy because rightfully so, you see the market run up a lot in a short period of time. You say, well, it's too much, too fast. Surely there has to be a pullback, and no question there will be a pullback. We just don't know when and how big it's going to be. But historically, if we're just being objective, just looking at the data, what has happened following the biggest short-term rally? So over a 13-week period, this is on a closing basis, S&P 500 rallies 24% this year. That's good for eighth place going back to 1989 in terms of ranking these rallies. And if we go back and look at these other examples and look at the next year, 100% of the time, the market was higher over the next year. And almost every single one of these examples, we saw a double-digit percent gain. The only one that didn't was 9.7%. So above average returns over the next year going forward. Does that guarantee anything? Absolutely not. But certainly what you could say by looking at this table is that strength tends to beget strength. There's momentum in markets. And just like on the downside, this is why it's weird for people and they can't understand it. They're like, weren't you saying a few months ago that when the market goes down a lot in a short period of time, it's extremely bullish over the next year? Yes, That's bullish as well because of the concept of mean reversion. People overshoot to the downside, but there's also this concept of momentum when the people see these big, enormous gains. I'm not saying it's rational. They tend to chase those gains and drive the market up even more. Now, again, I certainly wouldn't be shocked if the market was down a year from now, but you can't look at this in isolation and say this is a bearish thing that the market's gone up this much this fast.
But this time it's different, Charlie. This time it's different.
It's always different, right? So the question we were talking about valuations. What was the valuation on the S&P 500 today versus, let's say, like the 2009 example, right? There's no comparison. Or the valuation's much, much higher today. The CAPE ratio is multiples higher than where it was back then. Even 2020, the valuations were high, but not this high. So definitely on this table here, you have to go back to really the late 1990s to find a similar CAPE ratio. So the 1998 example would be probably the closest comp to that. And you can see what did the market do? It continued to run after 1998 for another year until it peaked in March 2000. So valuation very much not a timing indicator. And the odds suggest, as crazy as it seems, that the markets will be higher a year from now. How we're going to get there, I have no idea.
Maybe technology.
Maybe. And what a recovery. What a recovery. Because the last show that we did, we were seeing a meaningful trend reversal. We were seeing value stocks far outpacing growth stocks. We were seeing the Mag 7 lagging. I think all of them were pretty much down at the April lows on the year, and all of them underperforming the S&P 500. No longer the case today. As
We
we're
were talking
talking
about
today,
utilities, right? Utilities
yeah,
was
we're
winning.
talking utilities. I mean, it's crazy. But 43% advance in the tech sector from the lows. And you have NVIDIA today, this is breaking news, hitting $4 trillion for the first time, first company in history to hit that $4 trillion mark. And it's up significantly off of those April lows. So we've seen a reversal of the reversal, and the tech sector has been volatile versus the market. And every time you seem to count it out, like a few months ago, we thought, okay, maybe this is finally the time we see a change in trend. It just completely does a V reversal. The relative strength is not back to the highs yet from last summer. That was the peak. That was the highest level that we've seen ever. It actually surpassed the peak that we saw in March 2000 in terms of tech versus the market. But we're almost there. I mean, it's been such a rapid, incredible advance, and just cyclical sectors, as you often see when you flip from there's going to be a recession, which if you look at the betting markets, they were saying over 60% chance of a recession back on April 8th. Today, what are they saying? Around 20%. And when you have that flip, Caleb, what you do is you see money rush out of those defensive sectors, healthcare, staples, utilities, and rush into cyclicals like technology, industrials, consumer discretionary. So just textbook example of this.
And looking at some other asset classes too. I know, diversification is always a topic, and you're always preaching that you don't know which asset class is going to win, but is that any different this year, or are you seeing similar trends?
No different. Every year there's a different winner, different loser, but the message is the same. You can't predict at the start of the year who the winners and losers are going to be. The remarkable thing today, as we're talking July, is that a rising tide has really lifted all boats here. 100% of the asset classes in this table, and this is showing all the major asset classes that investors are invested in, likely in their portfolios, are positive. We haven't seen that at the end of a year since 2019, which was really a banner year for all asset classes. But across the board now, we have everything in the green, and gold is leading the way, which it was leading the way the last time we talked, and it's still doing well in the year. But it's kind of unusual because everyone was saying, I think that was the last question we got in the last show we did, if I'm remembering right. It was about gold.
I like to always finish off with the gold question. We'll do it again too.
Good, yeah. But the thought was, gold is doing so well because the markets are down. There's all this uncertainty. Well, now the markets are back at new all-time highs, and gold is still doing well. The difference is all these other asset classes have caught up a little bit, and they're positive as well. So stocks, bonds, commodities, crypto, everything now higher in 2025. And how's this going to look at the end of the year? We don't know, which is why you need to have a diversified portfolio, because we can't predict who the winner, who the loser is going to be in any given year, in any given decade. And the best defense against that ignorance, which we all have, is to just spread your bets.
Yeah. And I guess the one thing that's not depicted on this visual here, Charlie, is the dollar or cash, right? And that probably tells some of the story of what's going on with gold.
Yeah, no question. There's inverse correlation historically. It's not as big as you might assume, but definitely when dollar tends to be weak, gold tends to be stronger. And we saw the weakest first half for the dollar in the history of the dollar index. It goes back to March 1973, so pretty long time period. I went back and had to look at each and every year. Could not find a year where the dollar index for the first half was down more than this year. It was down over 10%. So no question, that's boosted the gold narrative, and it's boosted also, as we're going to talk about, international equity. So all of those foreign currencies that were going down against the dollar for most of the last decade, we've seen a complete reversal of that so far this year.
Well, let's take one more question before we jump into the reversal with international equities. Small caps kind of sitting down there at the very bottom. A question about whether tariffs have played an impact there, or played a role there in the impact. I'm also curious on your thoughts on high interest rates and how those are, just kind of hung around. Is that impacting small caps as well in what seems like a risk on environment?
Yeah, this has been a trend, right, for a long time. If you look at large caps to small caps, we're essentially back to the late 1990s in terms of that ratio. And every time it seems like we're going to see a reversal in this, we saw last year just an enormous small cap advance at one point, but then it pulled back. And every time it seems to pull back for a different reason. And so the narrative markets are all about stories. And so it's easy this year to tell a story of why domestic companies are trading weaker. If you look at the fundamentals, small cap earnings growth is still slower than large cap. So that's definitely driving. And as you mentioned, they've been disproportionately hit by the higher interest rate environment. But markets trade on the future, and at a certain point, they're going to discount that. And if interest rates, as we'll talk about later, if they're going to set to come down, well, then you could see this picture change in a hurry. So I don't think there's a reason to abandon small caps. If we look at that ratio similar to U.S. versus international, as we talked about a lot last year, we're seeing a reversal of that this year. At some point, there will be a reversal. We don't know when that's going to occur, and that's why you want to have mid caps, small caps in your portfolio, in addition to the large caps, which have done so very well over the last decade.
All right, well, let's jump into the next section. The world strikes back. I know this is a trend we've been talking about for a long time, and you've had plenty of people say, hey, the S&P 500 is enough to diversify and have as your whole investment portfolio from an equity perspective. I guess talk a little bit about this trend reversal and if you think that changes or creates a stronger argument against that position.
Yeah, by far the number at Creative Planning, we get a lot of questions from clients and advisors, and by far the number one question that was coming in at the end of the last year is why should I own anything other than the S&P 500? And then as a subset of that, why should I own anything other than the Mag 7? Right? And it was good reason why they were asking that, because if you look at the returns entering the year for U.S. versus international over the prior decade, the U.S. returns were more than double the international stock returns. U.S. did about 13% per year over the decade ending in 2024, and international stocks did a little bit under 6%. So when you have that type of differential, and you have the fact, as we've talked about, that the biggest U.S. companies are companies you're likely using every day, especially Apple and Amazon and Google and Microsoft. You're using their products every day, so you understand them, and the fundamental growth there has far outpaced anything else in the world. So all of that is true, but the only reason why you want to have something outside of that is the potential for the future to look different than the past. And so it's this example, and it doesn't look huge, but it's actually one of the biggest short-term differentials we've seen going back the last 40 years. In the first half, essentially international up almost 20%. You got the U.S. Stock market represented by the S&P 500 up about 7%. So that's a pretty big differential. And so the question is, well, is it too late to get international? Is now is all of the case to be made that that spread has converged? And as you can see from this chart here, very much no. Like that doesn't really make a dent. If we look at the last 17 years, when I posted this chart on X, I got a lot of like American flag responses and USA chants here. 592% for the S&P 500 the last 17 years versus 140% for international. MSCI World ex US, so everything outside the US, and 93% for emerging markets. So huge, enormous spread. And the situation coming into this year and even today is that this has created a huge valuation dispersion, right? So you have the US higher end of the valuation spectrum. And if we look at international stocks, emerging markets, they're actually below their historical averages in terms of valuation. So if we look at the next 10 years, we don't know where valuations are going to be, but if there is a reversal, you're going to benefit from having something outside the US. Has that ever happened before? Yes, but it's been a while from 2000 to 2010. If you look at that period of time, US stock market was actually down. International stocks, emerging market stocks were up. So you benefited from having that diversification. But the last 17 years, which is a pretty long time, it's been all about the United States. So I don't know what's going to happen the rest of the year. I doubt that huge spread that we're seeing is going to continue at that pace. But what I would say is there's still a very strong case to have something outside the US. And if we throw in that currency diversification that you get from owning international equities, I think that's good to have as well. Because hopefully, as an American, I want the dollar to be strong. Hopefully it is 10 years, 20 years from now. But if it's not and it weakens, well, you're going to want to have that diversification. You get that as an additional benefit through international equities when you hold them in your portfolio.
And Charlie, you mentioned the rising tide lifting all ships. When we looked at the asset class, quilt map there, it looks like pretty much every country, I mean, save a few, they're at the bottom, but I mean, a lot of green here, especially maybe surprising when you think about how much trade tension and rhetoric there has been around tariffs.
Incredible, right? If you just saw the headlines and then you saw this chart, you would say, "No way! How could this be? What is it? Is a trade war bullish for the markets?" I mean, so it's really the most interesting outcome. Kind of happens sometimes, and this to me is the most interesting outcome. Particularly, like who could have predicted? This is often the case, but who could have predicted Poland, Greece, and Spain as the three best performing countries so far this year? Absolutely no one. And that Europe, the Eurozone, would be up so strong. Eurozone up 29% so far this year. And now, yes, the US still has a decent return, but it's in the bottom third of returns. We haven't seen that in a long, long time where the US has not been in that left column, not just in that left column, but right near the top of it. So we've seen finally the benefits of diversifying outside the US. But as you mentioned, very few countries, surprisingly, down on this. I was just looking at before we started the show, I was looking at the Vietnam ETF, and it's just surging higher. And they just did a trade deal where they agreed to, I think, 20% tariff rate, and then they're not putting any tariff on the U.S. goods that are coming into their country. So the market's, I guess, essentially saying, well, that doesn't matter. That's not going to hurt them. I guess we're not going to be buying less goods, perhaps because goods are going to be shifting from China to Vietnam. They'll get that pickup in terms of, or maybe they're just removing that uncertainty. Who knows? But that kind of surprised me that it had this enormous rally before the agreement, and then it even surged even higher after. I think in here I'm showing like a 21% and change return. I think it's now up 30% on the year.
Wow. So I think one of the hard things to digest is whether or not these changes are impacted by the tariffs, or if the tariff impacts are still going to come. Looking at this chart, it was interesting for me to see just this effective rate, but I was hoping you could just expand on this a little bit and say, have we seen most of the market movement that's going to be as a result of these tariffs, or is it still just in the future? Nobody knows where to price it.
I think the jury's still out. If we look at if we look at where the rate is today, and I think once again, I don't think anyone believes a lot of the stuff. I mean, there was a comment yesterday that they're going to slap a 50% tariff on copper, and so every single day there's a new crazy headline, and almost always it's immediately reversed and pulled back. But overall, where it stands today, let's say nothing were to change meaningfully, and now we do have some trade deals as examples in terms of the rates. They're not super low. They're definitely much higher than before. Even the UK, which was actually running a deficit with us, we had a surplus with them. They agreed to a 10% tariff. So like overall, it's going higher. It's 16.5% right now as it stands today. That will be the highest since the 1930s. And in terms of the impacts economically, inflationary, all that stuff, I don't think it's happened yet. I don't think we can really see it. And I'll tell you a few reasons why. Number one would be just what happened in advance of this tariff announcement. So if we look at the first quarter data, Caleb, in terms of imports, exports, what GDP, what happened there, it was a crazy, crazy quarter. What we saw was essentially all of the companies that import goods internationally front running the increase in tariffs and doing a massive inventory build. So they thought that the tariff rate was going to go up. It has gone up. And so they essentially bought months and months worth of goods at those existing prices back in the first quarter. So we saw an enormous surge in the trade deficit, which is what they were trying to avert because companies were actually importing this massive amount, and that actually caused first quarter GDP to turn negative because of net exports. Now, because of that, we don't yet know when they have to replenish these inventories. Well, what prices are they going to be paying? Are they going to be then passing it on to consumers? We have just a few data points here and there. Nike talking about in their recent earnings call, they're going to have to start raising prices. Obviously, the tariff rates have gone up. Labor costs have gone up. Everything seems to be going up. They're going to be passing that on to consumers. But how much is it going to be? When's it going to happen? The jury's still out. And is it going to eventually lower overall trade, which would bring down overall the growth rates? How much is that going to happen? You could try to estimate it. I wouldn't suggest doing it. So my message for people when looking at this stuff is don't believe any of it is permanent. And even that 16.5% rate, let's say it stays there, Caleb, and it causes inflation to go up to 4%, and it causes the U.S. economy to pull back or global recession or something. How likely is it to stay there? Not very likely, because we have midterm elections coming up soon enough. People are going to want to get reelected. Then you're going to have the presidential election after that. So they're going to pull it back. They're going to change if they see that it's not working. So none of this is permanent. The idea that this is going to stay here for the next 30 years, I don't believe it whatsoever, especially if we start to see harmful effects from it. But it's just an amazing thing to watch the markets essentially shrug it off and say, everything's fine. It's going to be fine.
Yeah, I think it's one of those, fool me once situations too, where anybody that, reacted big to the first announcement, if there's some calluses being built up to not have
Yeah.
those big
Well, there
reactions
was
going
this
forward.
journalist who coined this phrase, and I don't think Trump took kindly to it. He called it the taco trade, that Trump always chickens out, and essentially saying every time he's come out and said, we're going to slap this rate or that rate, a day or two, they change it, or he does a pause, or he does an extension. Even the 90-day pause that they had just 2 days ago, they extended that till August 1st. So it seems like every time someone's in his ear, like people have suggested it's Scott Bessent, but who knows? Someone in his ear saying, you can't do that. That's too crazy. You got to pull it back. And then they pull it back. So it seems like market participants are becoming wise to that. And anytime there's a dip in the market, and the dips seem to be smaller when these announcements come out because no one seems to believe it. They seem to believe that it's going to be reversed. But again, overall message is jury's still out. We don't yet know the impact.
All right. Well, you mentioned Trump. We can't talk about a mid-year report without talking about the big, beautiful bill, right?
Oh, yes.
Break it down for us. What was in it?
It's big. I could attest to that because I'm one of the few people probably that's crazy enough to actually read some of the text.
I appreciated your summary because I didn't have it.
Now, whether you think it's beautiful or not, that depends who you are, if you're going to benefit or not going to benefit. So that's in the eyes of the beholder, I would say. But definitely it's big. And so what I did yesterday is I tried to summarize all the different tax policy changes that were in the bill. And we can talk about some of these. Like these are most likely to impact the people that are watching this. There's plenty of other stuff in the bill as well. But in terms of taxes, the biggest thing overall is that they extended the tax cuts from the last time, and that isn't in this table. But essentially, all of the tax rates that were lowered back in 2017, they were set to expire at the end of this year, and if they didn't pass a new bill, so within this bill, they extended those, made them permanent, so those tax rates will stay at those levels, so nobody should see a tax increase. Now, in addition to that, and this was obviously talked about on the campaign, but I think it was bigger ultimately than what most people expected. They threw in a whole host of new tax cuts, and depending on who you are, you may or may not benefit. The one that everyone's going to benefit potentially from, if you're taking the standard deduction, which most people do, most people don't itemize, particularly after the 2017 changes where they bumped that way up, is they increased the standard deduction from what it was supposed to be for this year. They increased 750 for single individuals, 31,500, so 1,500 for married filing jointly. So at the very least, many people will see some, even if it's a few $100s, decrease in their taxes. Now, after that, it really depends who you are. If you're a senior, 65 or older, and you make a certain amount, you can't make too much, you're going to get this huge bump up in your standard deduction. You're already getting a bump up, but they upped that by $6,000 per qualifying senior. So essentially, they took the wealthiest group in the United States by far, and they gave them an extra tax deduction. And we could debate whether that's good or bad, but I think that's absolutely incredible that they did that. And so 6,000 more if you're in this bucket. Now, many people in the seniors, they call this no tax on Social Security. Many people were already not paying any tax on Social Security because their income was too low. So it's only taxed if you make above a certain amount. If you make below 50,000, you're not likely to be taxed on that at all. But if you fit into this income ranges, which I have on the right, you'll get that deduction. Then the SALT, this was the big one, particularly for New York, California, all the people in high tax states with high property taxes, high state income taxes. Well, back in 2017, which angered a lot of people, they cut that to $10,000. They put a cap on that. And this time around, bumped it to 40,000 because essentially they needed those votes of the congressmen in New York. They needed those votes. They weren't going to get able to pass this bill, which was only passed by a small margin without those votes. So they bumped it up to 40,000, which will help you if you itemize and you live in one of these high tax states and you don't make them up above a certain amount. And then we'll very quickly talk about a few other things. Tips, overtime pay. Caleb, hopefully you put in your request to be paid in tips and only work overtime because now you're going to get a benefit on that. We'll see if that works for you. I don't think it's going to work for me, but you'll get a deduction there if you make within a certain amount for part of your tip income or overtime pay. Child tax credit was increased by a few $100s. That'll benefit people that have children. State and gift tax exemption. This is a big one. If you have an estate this big, which is very few people, but this was set to reset, drop down to 7 million at the end of this year for individuals, 14 million for couples, and they bumped it up to 15 million starting next year in 2026, and they made it permanent, which is a big change as well. So 15 and 30 million now. So you got to have a total estate if you're a couple above 30 million to hit that estate tax. Then we have this auto loan interest deduction. Vehicles made in the U.S. kind of, I guess, encouraging people to take out auto loans, which generally from a personal finance standpoint isn't something that's a good thing, taking out a loan on a depreciating asset and reaching to buy a car you can't afford. But they gave this deduction in there. It's an above the line deduction. Here's another one that everyone can benefit potentially. If you give money to a charity, normally before this year, you had to itemize your deductions, which most people don't. But now you can get a above the line deduction, 1,000 for single individuals, 2,000 for married filing jointly. And finally, we have the Trump accounts. I think that's what they're actually calling them, which is kind of unbelievable, but is what it is. Any child born this year or through 2028 will automatically receive $1,000 from the government. They're going to put it in an account. I don't know what it's going to be invested in, but they're saying a broad fund, so maybe like an S&P 500 index fund, and parents can add up to 5,000 a year into those accounts. So that's as quick as I can do that, Caleb, in terms of the major
That's
tax
great.
changes. A lot in there. And the big question now, of course, is well, what's all this going to do to the debt, the deficit, spending, revenue that's coming in? Because there was a lot of talk coming into the year after the election, before the election. We're going to cut the deficit. We're going to reduce spending. Some people were even saying we're going to balance the budget. Well, now you can throw all of that completely out the window after the passage of this bill. So the last 12 months, 7.1 trillion in spending. U.S. federal government, we took in 5.1 trillion in tax revenue. So let's start out with the 7.1 trillion number. Is that likely to go up or down? Up. So they reduce spending in some areas, increase spending in other areas. Net net, if we take into account interest payments on the debt and everything else, we're likely to be spending at least a few hundred billion more over the next year than this year. So that number goes up. How about the blue line there, the tax revenue? That's a little bit harder because we don't know what growth is going to be. But assuming, let's say, growth of a few percent, that number in the short run is likely to come down. Why? Because of everything we just showed you on that chart there, it costs money. We have less money coming in because we're giving out these deductions, these credits, the Trump accounts, the everything, all of that creates less revenue coming in. So what's going to happen to the deficit because of this? It's likely to widen. We're about 2 trillion right now. It'll probably widen by a few hundred billion would be my guess over the next year. Over the next decade, people are arguing, is it going to widen by, 3 trillion or 2 trillion or 4 trillion? I don't have the answer to that. But what I can likely say is we're not going to grow our way out of this big of a hole, right? So the big argument in favor of the tax cuts, and I love tax cuts, but not when you have a huge deficit. But the big argument is, well, we cut taxes, it's going to spur growth, and with higher growth, we're going to have more tax revenue. That's fine, but when you cut taxes by this much, in the short run, you're going to see a decline in that revenue. That's only going to make this deficit situation worse. And you didn't address overall, you did cut some things, but you spent more on others. You didn't address overall that red line, which has been the big problem. It's not so much the blue line. Tax revenue is 60% higher than it was a decade ago, Caleb. The red line, spending, has doubled over the last decade. So it's really a spending problem much more than a revenue problem. And now it's going to be both. Sorry to
I know
sorry to put a damper on everyone's summer here.
no, I mean, I think we could get into, talking about the policy for a long time. I'm gonna just move on. Understanding the fact that there's a lot still to discuss there, but certainly want to get into, one of everyone's favorite topics, which is the Fed. And I know, Charlie, you're a big fan of the Fed and their involvement in interest rate markets.
Love it.
I know your answer is always, stay out of it and let the market determine where the rates are. But I got to start by asking you, if it was up to you, would you cut rates in
No
September?
way. No way. 100% no. So, and I agree with the Fed holding the line here, by the way, and I don't often give the Fed credit, but I know there's a lot of pressure on them to cut rates coming out of the White House administration. Should cut rates today. I think today's tweet was they should cut rates by 3%. They should be 3% lower. So Powell's showing good restraint here. And if you look at the Fed's mandate, So I don't think the Fed should be determining interest rates. The market should be, but that's the system we have. And the Fed's mandate is to balance price stability and maximum employment, right? Those two things. And Powell's always talking about that. Let's start with price stability. They have a 2% target. Where is inflation? You could see in the chart. This is their preferred measure of inflation. So this is the one they look at most closely. 2.7%. You don't have to be a math genius to understand that's not 2%. And if you look at the Fed's projection for the remainder of this year, they're expecting it to go up. They could be wrong about that, but to me, if you look at the inflation side, this means no, you can't cut much more. They cut 100 basis points last year thinking this was going to go down to 2% at this point. It hasn't. It's remaining sticky. They're projecting it's going to go up from here over the next few months. How are you going to cut interest rates with that dynamic? Just looking at the price stability part, right? And then if we look at the next chart, this is my reasoning for they shouldn't even have cut last year because it's not 2% inflation. Even if it comes down to 2% over the last year, that doesn't erase all of the inflation before that. So we're seeing 4% inflation since the start of 2020 when the Fed went crazy printing money and we did that huge deficit spending. 4% per year, that's double the Fed's target. So until we may close this gap, I don't see any reason to cut interest rates, especially when the economy's still in an expansion. You have a stock market at all-time highs. It doesn't make any sense. Why should you be cutting interest rates? And then go to the next chart. We have the other side of the mandate, which is employment, maximum employment. And 4.1%, you're not far away from that maximum employment number. And this is the number the Fed looks most closely at, is that unemployment rate. And some people will argue it's not, this isn't a good representation, fine, but it's still well below the historical average. And if this were to meaningfully rise, let's say it goes 4.5, 0.4, 4.75%, the Fed's going to definitely lean on that to say they should cut rates regardless of where the inflation picture is. But for now, if it's this low and jobs are still growing every month, they can hold off. And what Powell's been saying is true in terms of the tariffs is we don't yet know what the impact's going to be in terms of inflation and everything else. So why not just wait and see? Because it doesn't seem to be hurting anyone by leaving interest rates where they are. Why not wait and see instead of being forced to potentially hike rates if we cut too early and then see an inflationary spike?
So, Charlie, I mean, obviously, two great arguments. I think the third point that has been coming up a lot is, if you go back to that last chart we looked at in the last section and the deficit and all the spending, the cost to refinance all of that outstanding debt and how expensive that will be if rates stay high. How do you think about that kind of third element in the picture and whether the Fed should be concerned about that?
Yeah, I mean that they're coming right out and saying that's why the Fed should cut rates now. It's going to save them. But that's a dangerous, dangerous precedent. If you have President of the United States or Congress or Senate telling the Fed, you got to lower interest rates because we can't control our spending and the deficit. We need you to cut rates to zero essentially so we could do whatever we want. And like that's not good because that's going to be highly inflationary. People are going to be losing their purchasing power very fast. That's not good for anyone. So Powell, when he gets that type of question, he often says, we're not in charge of fiscal policy. I wish you would say more than that, but we're not in charge of it. We're just focused on monetary policy. But clearly, there's people calling him to cut rates because of that. But I almost think it's a reason not to cut rates because if you do, then it's just going to encourage more of that bad behavior, which ultimately is going to put us in a bad place. So I don't view that as a justification for cutting interest rates whatsoever.
So this chart's fun. I looked back at our webinar we did, I think in September of last year, just because I was curious how much this line's moved over. I guess that's not quite a year, but almost a year. And I think
Yeah.
back in September of last year, the market expectations for where the Fed fund rate would be right now in in June, July of 26 was a full point or more lower than it is now. So I guess
Yeah.
talk through this, but also, is this reliable?
Yeah. No, don't count on it for more than one meeting, maybe two meetings in advance. It's going to change from what it looks like today. And let's talk first about why that happened. Why didn't the Fed cut as much as they thought? Well, they started out, I think you and I did a show right after that rate cut or right before it. They started out with 50 basis point cut, which I thought
Super
was
cut.
incredible. No need for that, but they started out with that big cut. And then what did long-term interest rates do? And this shocked a lot of people. They went up, not down. Mortgage rates went up, long-term rates went up. Essentially calling the Fed out, saying you shouldn't be cutting rates. Like the inflation is still a problem. You still have this problem with the debt and deficit. You shouldn't be cutting rates this aggressively. And so here we are today. Let's fast forward to today. What is the market pricing in today? It's pricing in 2 rate cuts this year. See you in September. First cut is in September. Second cut is in December. Is that going to happen? I don't know. Like the Fed's going to have to telegraph it when it meets in a few weeks because it always does that. So Powell, I think if they're going to cut in September, he'll give you kind of the clear guidelines. I don't think they should. Will they? Well, that depends on what happens with that inflation, which again, the Fed is projecting it's going to go up, not down, and employment, right? If we just see a collapse in the jobs market or a collapse in some other economic data, more likely to cut interest rates. But the Fed themselves in the last meeting, Caleb, they're projecting still 2 cuts. So this wouldn't be a shock to anyone. There's not much time in the year left, and they're still projecting 2 cuts. So clearly they want to cut 2 times. Will the data give them the opportunity to cut 2 times? I don't know. But I think the overall message, if you take the Fed at their word, and it's hard to do that because they change all the time, as the overall message is we're probably not going back to that super easy money policy that we saw for so long after the global financial crisis. I just think it's unrealistic to go back. Maybe if when Powell's replaced next year, if they put in someone that has that belief, maybe, but there's other voting members that can't do it by themselves, right? Like, I just think the idea of going back to that, as long as we're talking about we have 36 trillion in debt and we had a debt ceiling, and now we just raised that debt ceiling under that big, beautiful bill by 5 trillion. So very quickly here, we're going to hit 37 trillion, then 38 trillion, and we'll probably be talking about 40 trillion next year. I don't see how the Fed, like looking at the market, if they cut interest rates aggressively into that, I think the long end is going to go crazy, saying we're already engaging in inflationary behavior, and you're just adding fuel to the fire. So my hope is they don't cut it at all, but realistically, I think they want to cut. So if they get the data points they need, I wouldn't be shocked to see another 50 basis points this year.
All right, let's flip our last chart up here, which I think is some good news, right? And on
Great
a
news. This is the
positive note.
most important chart for an economy. If you put me on a desert island and I said, Charlie, you can only have one chart, this would be the chart. And the reason is simple. When people's earnings are going up more than inflation, it's a good thing. Your purchasing power goes up. You have more money to save. You have more money to invest. You have more money to spend. And that powers everything in terms of the economy, in terms of your household. This is what people care about, right? How much more am I making? How much am I bringing in versus how much am I spending because of inflation? And so now 25 consecutive months, we have people's wages going up more than the rate of inflation. That's a great thing for the American worker that hopefully continues. And as long as this continues, you have the economic engine continuing, right? As long as people have jobs and they're making more money than they did last year, and that more money is more than the rise in prices, they're going to be spending and the economy is going to be growing, and it's good for everyone. So hopefully this continues. And I would say this is yet another reason there's no rush to cut rates when you have this situation going on. You want to make sure that inflation component stays low. Why was it negative for 25 consecutive months before this? Because of inflation. Inflation was so high, people's wages weren't going up 9% in a year, but we had 9% inflation. So let's not go back to that scenario anytime soon.
All right. Great. So let's take some questions. Let's see. We got a lot that came in here. We didn't talk about Bitcoin, Charlie. What's your current take on Bitcoin? And I know we had it in that asset class chart. It I think it was near the top, just a little bit behind gold. Obviously still that huge gain over the long run, but with everything happening, with interest rates and currencies, is Bitcoin becoming more of a stable asset in your mind?
Stable, I don't know. The volatility is coming down. What's most interesting, I think, with the Bitcoin change in behavior has been that Bitcoin has become a risky asset that's highly correlated to the US stock market and more in particular US technology stocks. So if we look at like the NASDAQ 100. So that correlation continues to rise, and we actually saw that in the April downturn there. Bitcoin was down big, right? And then it was early to recover, and the market kind of followed it higher. Bitcoin went back to new highs before the market. So it's become really a risk on, risk off asset, similar to the equity market, but with much higher beta, so much higher volatility. And ultimately, whatever I always say about Bitcoin is it's a story asset. It's all about how much you buy into the story. And the biggest story for Bitcoin, the thing that supported it the most, in my view, over the last 5 years, is this idea that the US federal government and the US central bank cannot control themselves. They cannot be fiscally responsible. They can't be responsible with a money supply. So you need to have either some people view the equity market as their inflation hedge. Some people view Bitcoin. Some people view gold. But the idea of having an alternative currency outside of fiat, outside of the dollar, as long as we're printing money and we're creating inflation, and we're essentially telling you we're going to continue to do that by running these massive deficits. And if you just look at M2, the money supply, we pulled it back for a little while after that crazy spike, but now we're printing again. The printer is back on. And so more than anything else, that story is there's a limited supply of Bitcoin, and the supply of fiat just keeps going up and up and up. So as far as the price targets, just throw all that nonsense out. Like every day someone's on there talking about a different price. No one knows where it's going to be, but that's the narrative most in support of Bitcoin. So I would say the thing that would hurt the Bitcoin the most would be if we did actually balance the budget, if we did control the money supply and control inflation. That would be the case saying we don't need an alternative currency, but we're not there today.
So as a big fan of diversification though, and looking at that asset class chart, do you think a small allocation to Bitcoin or to cryptocurrencies is a part of an overall diversification strategy now?
It's hard. You have to be prepared to have extra volatility. So even a little bit of it in your portfolio. So if Bitcoin's at an all-time high, right? So if you just back test it and throw it in, any allocations are going to look great, right? But the problem is if you put a meaningful weight in it, it's going to very quickly dominate your whole portfolio. So your whole portfolio is just going to look like Bitcoin with either less leverage or more leverage depending on it. So that's an individual choice. Do I want to own something that has no underlying fundamentals, right? Similar to gold, and it's just based on a story. I can't value it. I don't, there's no earnings, there's no cash flow. That's an individual thing. So I told you why people value it because of that story, because of the limited supply. As far as how much to put in your portfolio and whether you think that's a good idea, I think that's an individual choice. People have to evaluate that and really how much risk do you want to take, how much can you lose, how much, all the rest of it, right? So Bitcoin very frequently has gone down 50%. It's gone down 80% a few times. So people, if that happened in their equity portfolios, they'd be going crazy, right? That's essentially the Great Depression has happened multiple times in Bitcoin's history already. So it's just a very different animal, I think, for most people. And when it's at all-time highs, everyone loves it. When it's down, everyone hates it. So in that case, it's no different, right,
Yeah.
than any asset class.
All right, a couple questions came in. Charlie, you mentioned the volatility of volatility, and you talked about kind of the speed of which markets are reacting to things both on the upside and the downside, and that trend. Is that a trend that you expect to continue? And you know, if so, why? And if not, I guess what would slow that trend down?
I do. I just think all the evidence points to everyone's more focused short term. Social media has proliferated, right? The short term news on the positive, on the negative side, more so on the negative side, I would say. And so things just happen much quicker. They react much quicker. And so All of these new products that are coming out where you can get leverage very quickly in terms of options, futures, we just see continued increases in terms of their usage, right? So they're dominating things more and more. So yeah, I think that's kind of become a feature, right? And every time I think like the meme stock stuff that happened a few years ago won't happen again, there's another example of it happening. It's just a different name or a different thing where you have this crowd behavior just surging into something. So that's a different phenomenon as well. But I think for most people, they'd be better served kind of ignoring that stuff. But like I said earlier, it's hard to do. And if you're making changes in your portfolio, let's say rebalancing, or you're thinking you like to be proactive during market declines, so you like to buy into a decline, or with long-term money, with money that you have set aside, just gonna have to probably be quicker with it. So all the evidence is pointing to it until I see otherwise, and we see it especially with the VIX. I mean, it's just crazy how quickly it goes from absolute panic. So we saw the biggest volatility crash in history. We saw it spike. The VIX spiked over 60, Caleb, back in April. Now it's at 15. So like we have never seen that before, that quick, going from it's extreme panic, everyone's losing their minds, the end of the world, and today it's like everything's calm. It's summer. Let's go to the beach.
Well, I guess it will support a more interesting webinar next time we get together, Charlie. Things do keep moving fast, and the market keeps reacting to news quickly. So I
Yeah.
guess in that regard, you can bring it on. Look forward to doing this again soon. Thank you so much for being here with us this quarter, and for all your insights, which are having a big impact on me. So I appreciate it, and I think I speak for
Awesome.
everybody else when I say thank you.
Thanks so much, Caleb, and thank you everyone for joining us. Have a great rest of the summer.